With the avoidance of doubt, the simple side does not provide investment, tax, or legal advice. As with any asset, the value of any asset class can go up or down, and there can be substantial risk that you lose your money buying, selling, holding, or investing in any asset. You should carefully consider whether trading or holding assets is suitable for you in light of your financial condition.
Even though portfolios were down this week, we do have some good news. The simple side reached over $1 million in assets under management on Autopilot. Of course, the world doesn't stop turning when that happens, so we still got a bunch of news that happened this past week, and we're going to talk about why the market dropped on Friday. Let's get into it.
Welcome to the simple side. Market beating picks inside. There's no jargon and no time to waste. Join the simple side and end up in first place.
All right, everybody, I just want to say thank you again for $1 million in assets under management on Autopilot. It's super cool to see that happening, and it's even better to know that all the portfolio returns are positive, they look good, and that we are making people money on the platform, and that is just so awesome to see. As a reminder, you can go and copy trade those portfolios through the links that are in the newsletter. You'll find them all over the place. And you can find the podcast on YouTube, Spotify, Apple Music, and our daily newsletter you can find at thesimplesidedaily.substack.com, thesimplesidedaily.substack.com. So go and check that out there. All right, everybody, let's talk about what happened in the markets this week. It's going to be a short podcast today. We're just going to talk about what happened in the markets. I'm going to give some market commentary, just my opinion on everything that's been going on. And then we'll talk a little bit about the interesting trades. And then I'll let you guys read the rest of it. I'm not going to get into the insider trade updates, and I'm not going to talk too much about portfolios and performance and all that stuff, but you should go through and read it. There's a ton of good stuff about data. There's a ton of good stuff about, I say data as if it's something really specific. There's a ton of good stuff about our strategy and some of the things that we're looking at. And so be sure to go and check all that out. All right, let's get into it for this past week. Returns this week were brought to you by early week record highs powered by the AI and rate cut hopes. And of course, a late week trade war shock that flipped everything red. My comment here is basically just, how we haven't learned. It's funny how we kind of felt the same thing happen earlier in the year. Trump trade war news, stock market drops, everybody's terrified. It's the end of ages. And it's like we don't remember that happening at all. And the fact that we've rebounded incredibly from all those lows. And so watching things sell off is just crazy. We've seen the same playbook before. We've seen what the outcome typically is, and yet we're still selling off in vast droves. Of course, we didn't sell anything off over that period. We're just sitting there watching everybody do do a bunch of craziness, a bunch of panic selling. Of course, the same playbook that we've seen happen is big threat, turns into a big market drop, turns into nothing major happening, and then that turns into stock returns. So we're not doing anything right now. We'll watch and see if anything substantial comes out of this. If anything, it just means stocks are cheap right now, so DCAs are becoming more valuable. So again, just not super worried about all this stuff. The trade wars that are in the news are just that. They're trade wars in the news. Remember, the media is selling you fear or greed. They're not selling you good stock picks. They make their money from you watching, not from you making good investment decisions. That being said, the Nasdaq and the S&P 500 did notch fresh intraday highs as investors leaned big into big tech and semis. Treasury yields hovered around 4.1% on the 10-year, which drifted lower midweek, typically helping growth stocks, and we definitely felt that in our portfolios. Oil spent most of the week around $61, $62 a barrel, which is cheap versus the past couple of years. Then, of course, this eased costs for shippers, airlines, and consumers. And, of course, this does pressure energy company profits, but at least it's spending in other areas. So it's good to see oil coming down. Gold, of course, is staying near its all-time high of around $4,000 an ounce, which, of course, tells you that money is still buying insurance against all of the current political and economic shocks, even while indexes are near highs. Again, we have around 50% of our investable dollars, if you will, in cash, and this is one of the reasons why. you can tell that people are getting more and more sketched out as it is by the current state of the market. And so my hedge against that is to hold cash and prepare to invest when things come down. Other people are buying gold, other people are buying other things, but as of right now, we're just holding cash. We might look at making some investments outside of the United States, just to hedge against dollar devaluation. But as of now, we're not too worried about it. Of course, when Friday hit, things got brutal. A fresh threat of massive U.S. tariffs on China sent risk assets into the reverse. The Nasdaq dropped 3.5% on the day. S&P 500 fell 3%, and the Dow slid down 2%. Of course, when investors fear slower global trade and higher costs, they dump cyclical and mega cap winners first and buy into some safer assets. But you saw how everything panned out. I mean, we saw Treasuries slip. We saw gold pop. We saw oil sink below 60 as growth worries rose. The dollar eased. And of course, crypto struggled to maintain its levels. Now, with all that being said, I want you to remember what I called out last week. We saw the shift in institutional money to defensive, specifically healthcare, and that's been happening for about a month now. We saw tons of retail investors selling CNC, UNH, MOH, etc. And it's no surprise that this shift has been happening for about a month. And of course, it happens just in time for growth in cyclicals and everything else to start to take a tumble. Again, I mean, this is how it works, and it's very clear, but we seem to get trapped by news, and then everything seems like the world's falling apart, even though the signs have been there all along. In the big company moves section, we've got banking just getting bigger and bigger. Fifth Third agreed to buy Commercia in an all-stock deal valuing Commercia at roughly a 20% premium. This would create the 9th largest U.S. bank by assets if regulators sign off. Divestitures, of course, are common in big deals like this, and we will likely see the same thing happen here. Chips and AI stayed center stage. AMD, of course, ripping higher after OpenAI committed to deploy roughly 6 gigawatts of AMD GPUs, a huge signal that AI spending is shifting from demos to data center buildouts. NVIDIA, of course, grabbed its own headline later in the week with a U.S. approval to ship certain AI chips to the UAE as part of a broader investment pact. TSM, Taiwanese semi, of course, saw September sales jump more than 30% year over year, which again is another sign that the AI parts pipeline is still humming. And of course, all of that was great up until the tariff worries sparked a broad semi sell-off on Friday. Tesla, of course, teased a cheaper Model Y configuration after posting record quarterly deliveries, in an attempt to keep volume growing now that $7,500 EV tax incentive has expired. Ford, of course, is facing a potential material squeeze after a major aluminum supplier's plant started fire. And this is, of course, important to modern pickups because a majority of them are aluminum heavy. Boeing, of course, is preparing to lift its 737 MAX production. Of course, the FAA is going to have to sign off on that, but if it does happen, that's definitely going to be needed, and it will be good for their books. And as we all saw in the news, deal and policy tape bombs continue to come. HSBC floated a plan to take Hang Seng Bank private, amplifying its Asia structure. Novo Nordisk moved to buy Akero to deepen its metabolic disease pipeline. Microsoft is baking Harvard Health content into the Copilot, so health answers are sourced and safer. And of course, those same late day Friday tariff headlines led the entire market lower. Mega cap, techs, semis, retailers, and of course, import heavy names fell the most. Classic defensives like consumer staples held up better. Pepsi, of course, was a big rallier during the Friday sell-off on an earnings beat and a CFO change. Now, of course, I have lots of opinions on the things above, but a few things really stand out to me as opportunities here. Novo Nordisk purchase of Akero and Pepsi's movement. Now, if we start with Novo, their acquisition of AKRO is interesting to me, and it could have potential large payoffs for Novo in the future. While Acaro is not profitable, they hold basically no debt. So the company's not buying into any debt. They've got, 36 million in debt, 743 million in cash. And Novo stock is down 52% year over year, but revenue growth still looks solid. Things slowed in Q1 of 2025, but they seem to be picking up a bit of steam now. Does the company's current valuation warrant the 52% sell-off that we saw earlier? I don't think so. I think the fact that they're out there making acquisitions shows the fact that they're not worried about the stock dropping in price. And so it might be a good place to try to pick up some shares at a really cheap value, especially in a healthcare sector that is usually performing quite well in market downturns. Of course, Pepsi's recent move should come as no surprise. The company owns around 11% of Celsius stock, which has been growing unreasonably quick and still has very stable revenues and margins. In fact, net margin even looks to be increasing. I think that if things continue to shift defensive, Pepsi will be seen as an undervalued defensive play and will likely outperform, in a bear market. Now, at the very end of the road, there are two forces pulling in opposite directions. One side falling, or even just stable. Rates, of course, and real AI orders that are good for profits and valuations. On the other side, we've got new tariffs that would raise input costs, and risk retaliation from China, which could reignite inflation, as we saw before. And this, of course, coming on the heels of the Fed inching towards cutting rates. Of course, that mix explains why gold is elevated and has remained elevated, why oil is soft, and why the VIX, of course, perked up into the weekend. People are paying for protection. Now, in the near term, price movements are going to be driven by three things: trade headlines, earnings season, and yields. So pay attention to all of those over the next couple weeks and months. As always, I just want to make one comment on this news. The actual path forward is going to be anybody's guess. Nobody really knows what's going to happen, but I would assume the following going into the end of the year. The China tariffs are probably going to be nothing burgers, and the rate cuts that are probably going to happen will happen most likely in October, and we will probably see yields coming down. Of course, I do want to highlight one of the interesting trade ideas that we had this week. I'm skipping down quite a bit in the newsletter, so if you're following along on the newsletter at thesimpleside.substack.com, I'm jumping down a bit here. But I mentioned Kenvue last weekend, and we bought that at market open Monday at $15.86. The stock's up about 5% since then at $16.65 a share. I sold some covered call options, and some of those were at the $16 range, and so if we did get assigned on those, which I haven't gotten a notification that I've been assigned yet, but if I get assigned, I'll have to take a 1% gain plus, the $10 per contract. And so while that isn't great, I would love to keep those shares. On the off chance that I do get assigned, it means that I've taken a 1% return on a week where the market dropped 3%. So I'm not super upset there. If you joined me in that Kenvue purchase and you haven't been assigned on any of your shares, you're going to be beating the S&P 500 this week by around 8%. Kenvue was up about 5%. The market's down about 3%. So an 8% beat on the week on that one company. So just great fortune on the timing of that purchase. As I said before, guys, $1 million in assets under management. Thank you so much for that. Our portfolios, since we put them on Autopilot, are up 25.74%, 24.41%, and 5.79%. And that's just in about a 2-month period. So we've got $1 million that are now following those portfolios, and we expect the returns to continue to be incredible. Thank you guys again. I've got a bunch of analysis and strategy that I've written about in today's newsletter. So go through and read all of that. I think it's going to be beneficial just for your thought process, just for your psychology in the current market. So go and read about all that stuff, guys. And I will be seeing you, as always, next weekend.